Hey everyone, welcome back to the channel. I'm here with another episode of Talking Charts. This is the Scouting Report edition. I got my friend Larry Thompson on the channel once again. You can follow him on Twitter at Hostile Charts. Thanks for joining me, Larry.
Yeah, man, excited to be here. Excited to look through some charts, kind of give people a perspective of the market that hopefully they haven't seen this week. So,
Yeah, so Larry sent some charts over. We're gonna dig through those, and I got a few charts that I'm watching as well. But let's just jump right into it.
yeah.
So the first thing we're gonna start with, Larry, as I often do on my channel, is start by looking at the indexes. So we got the S&P 500. What are you seeing here? This is Larry's chart, by the way.
Yeah, so looking at the S&P 500, there's a few things I just wanted to highlight, right? Like it doesn't take a rocket scientist to realize that we kind of hit overhead resistance at the 4,600 level. The thing I just wanted to highlight with this chart is on the way up is when you should be starting to add risk levels and potential support on the way down, right? You want to assess the future probability of a downturn on the way up, not once it starts to turn down. So that's the main thing I just kind of wanted to highlight here. I think people are missing is, oh, when are we going to start going back up, right? But a more important idea is making sure you're managing risk while we're going up. And so one way I did that here is I just drew some horizontal levels on the AD line and also the S&P 500. What you can see is, right, we kind of got stuffed. We broke the 50-day, and now we're kind of heading back to the 4,300 level, which if we break that level, the next level of support would be around 4,180, 4,200. So those are kind of the areas I'm monitoring. Looking at RSI, you can kind of see we've broken below 50, which we don't like to see because normally we like to see stay above 50 in the uptrend, which we kind of seen earlier in some of the pullbacks throughout the year. The AD line looks interesting. I think we're kind of back at those August highs from last year. It'd be nice to see a bounce here, and also that kind of coincided with a bounce in the S&P 500. We'll kind of see how that plays out, but to me, we're kind of getting a little bit extended on the short term in terms of some of the downside pressure that we've been facing. So I think looking at this 4,300 level and seeing how the ADX line responds this upcoming week might be helpful to see kind of, all right, is this the end of the phase of the pullback, or is the pullback going to kind of gain steam this week? Those are kind of the levels I'm highlighting.
Yeah, for sure. And I agree with you that while we have been pulling back, and I think we could ultimately pull back further, one encouraging thing I noted on Friday was that XLK and the semiconductor ETF SMH both ended the day green while the index is still closed down. But those are risk on areas of the market that have gotten hit pretty hard lately. And so the fact that, maybe those start to put in some sort of potential bottom, whether it's a short-term bottom for a dead cat bounce or something like that'd be something to monitor. So that's something I'm monitoring as I look towards the new week. I think we could ultimately head lower, but don't be surprised if we get a little bounce before that happens.
Yeah.
The new highs, new lows chart. What do you got to say here? I can see that after new highs were really dominating for a while. We're starting to see the balance shift and starting to see some more new lows, more new net lows. So what do you got? What do you got here?
Yeah. So the thing I would just add here is, as we started to hit that 4,600, you could see that the new highs was starting to peak, right? So you kind of want to use these things in tandem. You want to look at breadth, you want to look at price, you want to look at momentum in tandem to kind of see what levels occur and what kind of when the breakdowns are going to happen, right? Haven't been able to be on the past couple of weeks because of some vacationing, etc. But these are the areas we were looking at to kind of see, okay, the market was waning. So what do we want to see if we start to form a bottom, right? We'll never know if it's the bottom until, it already occurs. But things that we'll want to see is we'll want to start to see the net new lows dissipate, right? We'll want to see net new highs start to outpace net new lows again. Right now, we're not seeing that. So that's why I'm just being a little more patient with the process of this bottoming. But it's something you just want to use in tandem with price to kind of see what's occurring underneath the surface of the indexes.
Yeah, definitely. And I think something to point out, which you can clearly see on your chart here, is that the new highs versus new lows, net new highs versus new lows, did flip pretty red during March, and that wasn't the end of everything. So it's not. I don't think it's necessarily a reason to hit the panic button, but something to monitor.
Exactly.
Next up, you got your advanced decline lines. What are you seeing here? We got three charts. Can you walk me through these?
Yeah, so I like to look at the advanced decline lines on each level of the market cap weighting. So you have small cap, mid cap, large cap. The reason I like to do this because I want to make sure I'm fishing in the ponds where, right, there's more potential of catching a fish, right? So the AD line for the S&P 500 has been the one that's performed the best this year, and it's actually looks like the one that might hold its August high, right? We knew the 400 and 600 have been the ones that have been struggling, and those were the first to kind of break below their August highs. And so what we want to see is if the S&P 500 can kind of lead, which it's already done this year, right? The S&P 500 large cap tech, large cap in general has kind of led the market. And if you actually look at this past week, which Justin kind of mentioned, XLK was the strongest performing sector this week, right? Which if we'll get into it later, if yields are going to rise, consensus is yields are going up, it's doom and gloom for large cap tech, right? Let's see if that narrative is actually going to play out in price, right? So that's kind of how we want to look at this and kind of see, okay, maybe we're still, even though, the market's kind of getting hit, we still want to look at large caps, look at the S&P 500 for names to be buying, not necessarily small caps, right? I'm sure Justin can find me a chart of a small cap that looks great, but in general, you just want to fish in a pond that has the most fish.
Definitely. Before we go to the next slide, the S&P 400, S&P 600, can you just explain what those are really quick?
Yeah, so the S&P 600 is the small caps stocks, right?
Okay.
And then S&P 400 is mid cap stocks, right? So it's two different branches. This all together makes up the S&P 1500. But in general, people focus on the S&P 500, but we like to look underneath the surface at other areas of the market to see how they're performing. And you can see earlier in this year, we had both, all three kind of bottom, which was confirmation of the bull leg. And that's when you saw the greatest expansion in the new highs and the new lows. So kind of use it in tandem.
Yeah, gotcha. All right, next one. So this is a variation of a chart that I've shared on Twitter before. I've also covered it in prior YouTube channels, but this is the New York Stock Exchange FANG. This is the FANG Plus index. Yeah. So this is the FANG Plus index, which is made up of 10 equally weighted stocks. Larry's got them over here. You can see we got Meta, Apple, Amazon, Netflix, Microsoft. Tesla's also in there, a few other ones. But yeah, so this was these stocks were really carrying the market for much of the year, but we're starting to see some weakness of a potential topping pattern here. So I want to just walk people through exactly what you're seeing on this chart.
Yeah, so I tried to keep this chart pretty clean for you guys and just show the downtrend break versus the uptrend break. I have a version of this that looks a lot more messy. There's some horizontal levels in between here that were tested, but I just wanted to highlight, right, we broke the downtrend back in February of this year, and that's when people started to get concerned, right? People were really concerned about breadth, but Justin and I knew, because we kind of worked together, we knew that if the largest companies in the world were outperforming, that breadth was not as large of a concern yet, right? We would wait for the largest companies to start underperforming before we would need the participants of the bench, right? Just like in basketball, if LeBron's on the field and he's scoring all the points, right? If he's on the court scoring all the points, it's okay that the bench is chilling, right? Mm-hmm. But it's when LeBron comes off the court and the bench players have to start to participate, that's when we need breadth. So this isn't the end of the world if the largest companies in the world start to underperform a little bit. It just means we might need breadth, or, right, it means if this is going to happen, that it's going to be really hard for the market cap weighted indexes to outperform. So that's maybe where you start to look other places to get outperformance, not necessarily large cap tech. So it's just another variation of where do we want to look to buy stocks? Where do we want to look to see if the market's bottoming? And where can we position money to where we can get relative outperformance if, the largest companies in the world are going to underperform for a little bit?
Yeah, and I think you brought up a good point there that if these mega cap, large cap stocks start to underperform, it's going to put pressure on the indexes, but it doesn't necessarily mean that we'll be in an environment where it's impossible to make money. So I think that's something that both traders and investors should really take to heart, because that's very important. Yeah. Next slide. So this is a chart of mine. As you can tell, the formatting is a little different, But I just wanted to show the small caps, how the small caps are performing. So this is IWM, chart I've shared before. And what happened here is we're really underperforming the indexes, definitely underperforming those large and mega cap tech stocks. But we did break this downtrend that had been in place since late 2021. So that was encouraging. But we're pulling back with the broader market here. We pulled back into this green line here. That's the 30-week moving average, which is something I like to watch. But overall, when I look at small caps here, yes, we pulled back, but we're not breaking market structure yet. So I don't think there's any particular reason to panic. That being said, when I look at IWM, it did struggle to reclaim these highs which date back to early 2023 and also the prior summer highs. So the summer 2022 highs, we were unable to get back above that level. So I think that's probably an important line in the sand to watch going forward. But when we look at small caps, pulling back into a potential area of support here. We want to see how they react and if they can, gain traction going forward. But don't see any reason to panic on small caps just yet. But I think something that'll be interesting to watch going forward, especially as it relates to the FANG Plus chart that you shared recently or previously, is if we do potentially see some rotation into other areas of the market outside of those large and mega cap tech stocks. So definitely something to watch. You got anything to add on small caps?
No, nothing to really add here. The thing I would just add is that, right, when trend starts to change is when things look confusing for trend followers, right? So right now you're seeing the medium-term trend is up, right? Short-term trend is kind of down. And it's going to be a battle in between. When is the medium-term trend going to return, or is the short-term trend going to become the medium-term trend? And so that's why we're just looking under the surface and we're just looking at the clues we have in the market because we don't know what's going to happen moving forward, right? We're just doing the research. That way we can react once it happens. And I think Justin's just doing a good job highlighting here. Just because we're sharing bearish charts or charts that are going down doesn't mean we're panicking. It just means we're sharing the information that's in real time so we can react at certain levels. So just keep that in mind when you're kind of dissecting this video. We're not overly bearish. We're just showing you charts, and it just so happens a lot of things are going down in the short term.
Yeah, absolutely. Another chart I wanted to share. So this is another one of mine. This is another one of mine. So this is the All World Index. This is the MSCI ETF. This ETF essentially gives you exposure to the global stock market. And that's why I've shared it in prior videos before, and I've shared it on Twitter. And in the previous times that I've shared it, I kept pointing out that this important level, which is around $93, you could see we tested it and were rejected at it several times. The most recent time that we got rejected at it on the way up, we pulled back and we didn't have a sharp sell-off like we had in the past. So we consolidated under that resistance. We're able to break above it and had a pretty nice run. But as we saw with the S&P 500 with US stocks, the global stock market is also pulling back right now, but it's at a level, it's coming back into this key support level. So this is not an area where I would look to short the global stock market or to short ACWI, because the risk reward is not in your favor right now. If anything, I think this is a potential area of support, an area where we could see a bounce, and we'll have to see, how that develops. But it is encouraging that we're still holding that support level. We haven't broken that level yet. So I know you said you like this chart. Is there anything that you're seeing when you kind of look outside the US? Anything that's catching your eye or anything to add on this particular chart?
Yeah, so in general, outside the US, you're just going to get less tech exposure, right? And so in general, the yield relationship with growthy tech names is inverse. So yields rising, the US may underperform. But I like the fact that you're highlighting this chart because once again, you're just showing a level and you're showing very similar to football, right? Run, pass option, right? Long, short option, right? So if we're above 93, it's a long, right? If we're below 93, you could use that as your risk level for a short. But the point is just have the levels defined and know how to potentially react once it occurs. You don't need to predict which direction it's going to go, right? The underlying trend is up. So we see that level, and that's kind of how we're going to play it. And that's the key that I think a lot of people don't focus on in the moment when it comes to a pullback, is they see a pullback and they just automatically panic. But it's no, draw your lines, understand your levels, and then react once we get to those levels. And I just think you do a great job with this chart showing that.
I appreciate it. Very nice of you, Larry. Now we're circling back to one of your charts. This is a chart that I've shared a version of this on Twitter. I've discussed it in prior YouTube videos. You're seeing a lot of people talk about rates right now. So we're looking at the 10-year US Treasury yield right here. What do you got to say about this one? So this is a chart that's spooking a lot of people.
Yeah, it's pretty lame, honestly. It's just annoying to me that it's so consensus right now that yields are going to go up and that yields hurt companies. For one thing, right, during the day I work as a CPA, so I understand, I create financial statements for companies, I audit companies, right? I understand the fundamental side of business and how interest rates affects those. That's not the point of this channel. I think two things I want to mention here is, one, look at the rate of change, right? In general, companies like certainty. And so when they can have more certainty about the direction of rates, that in general is a positive for companies. And I think what we're seeing here is that the rate of change is slowing, which to me is a tailwind. The headwind is if absolute change in rates continues higher, that's going to be a headwind for the markets. The problem is it's so consensus right now. This is just as consensus as the recession was, in my opinion, right? Based on some of the positioning we're seeing, it's become very consensus. And there's really only one thing we know, is that the market is going to fool the majority of the people, and you're going to have to pay taxes and you're going to die, right? We know a few things for certain. So we don't know for certain that rates are going to go up, but we know for certain that the market's made to fool people the majority of the time. So I'm just a little bit cautious here, especially when you look at the fact that all country world index is sitting right at support. Growth outperformed value this past week. We talked a little bit about how tech was the best performing sector this past week. So to me, just be prepared for both situations, because I think based on some of these charts, yields could maybe just pull back a little bit, right? They don't need to break down. Nothing crazy needs to happen, but we just need a little bit more confusion in the market, I think, than we currently have. And right, it's unfortunate. I'm positioned just like everyone else. If rates go higher, I'll probably lessen my exposure to tech and growth, but I think you just have to be cautious around just assuming that it's just going to be this, all right, rates are up, the market's going to continue down infinitum forever. It's like, it's not going to be that easy.
Yeah, no, for sure. I don't think it would be, for me, particularly surprising, because it's such a consensus view right now that rates are going to rip and everything is going to fall apart. If rates do pull back a little bit, we see bonds rally, and then maybe that sucks in some more bulls into stocks, and that plays out for a little bit, and then after a little while, rates eventually rip higher when less people are expecting it. Because right now, I'm glad you shared this chart, but there's variations of this chart all over Twitter right now. It's what everyone's talking about, and everyone's a little spooked by what's happening in the treasury market and the bond market right now. But as you mentioned, the market tends to fool the majority, so definitely something to be mindful of. Speaking of bonds, so here we got TLT, and I can see that you're pointing out something here. You're pointing out some potential bullish divergence in the RSI, and do you think we could potentially be setting up for a rally in bonds that would catch a lot of people off guard?
Yes. So just want to give a quick shout out to David Lundgren. He's a CMT. He runs a podcast with Tyler Wood, part of the CMT association called Fill the Gap. And one thing David Lundgren talks a lot about is, once you have your thesis, you should spend the majority of your time trying to disprove it. Because if you spend the majority of your time already after you have your thesis proving your thesis, you're just creating confirmation bias. So all I'm trying to do is, once we have the thesis that rates are higher, which is consensus currently, I just want to look for ways to disprove it, or look for positioning where people are off sides before we get the follow through, right? Kind of looking at, if you look at tech, right? everyone was off sides in positioning in October of last year, peak pessimism, right? That's why we rallied, because positioning reaches a point where the other side has to make money at. It's just how the markets work. And so my thought process here is that positioning for yields, it seems like everyone is getting short, and for bonds, right, everyone's getting short. So there could be a quick snapback rally in bonds where you could make a little bit of money on the short term, right? Still have your positioning as if yields are going to go higher, but short term make a little alpha. And so this is just a contrarian play I'm looking at, is seeing the divergence in the RSI, hearing of all the news around everyone thinking yields are higher, seeing, you know, is at my grandma's the other day, and on the TV, they're talking about mortgage rates hitting new highs. My grandma doesn't even have a mortgage and she's worried about mortgages, right? So yeah. It's just, that's some of the sentiment information that we're getting. And so I just want to be ready and positioned, right, short term to maybe buy some. I currently have some TLT calls just because, right, positioning could just get off sides for a couple of days and I can make a little money there. But it's just interesting to me, right? Same thing with gold, right? People talked about gold, and gold looked good, gold looked good, but it was just too consensus that gold is going to break out right when regional banks fail, right? And that it just feels the same way to me here, that, you know, bonds are just going to have to fail soon as rates go higher. Well, I think Mr. Market might be fooling some people here in a few weeks.
Hear that. Next up, another one of your charts. You got the Cash COWZ ETF. So I hadn't heard of this ETF until you brought it to my attention. And I imagine there's a lot of people watching this right now who, you know, aren't familiar with these ETFs. So can you kind of, before you get into what you're seeing on the chart, can you want to just explain what the ETF is and you know, why, you know, people should care about it, and then tell us what you're seeing on the chart?
Yeah. So a couple things, right? So talking about COWZ, it's so Pacer US Cash COWZ 100 ETF. Right, it has about 14 billion is the market cap of it. And what this does is it tracks the free cash flow yield of the top 100 companies based on free cash flow, right? So there's a few things, right? We know in general, if you're a passive investor in the United States, you're overweight tech. Why? Because passive index funds are overweight tech in the United States because they're buying the S&P 500, which has a large tech exposure. What are you also? You're also underweight energy. And we've seen when yields are rising that tech kind of gets hit and energy tends to do better, because energy and yields actually have a direct correlation, which I should have showed you guys this chart, but we'll talk about it later. So what we want to do is we just want to, for the average person at home, maybe add some additional energy exposure via an ETF like COWZ, where you have a nice level to manage risk against at 50. You've seen the outperformance in it on a relative basis compared to the average stock in the market. And you can quickly get almost 10x the amount of energy exposure that you're getting with the S&P 500. Because the S&P 500 has roughly 4% energy, and this has 36% energy. Last thing I would add from a fundamental perspective is that when interest rates rise, the value of your dollar in the present becomes greater, right? So as interest rates rise, people care more about current cash flows, right? So companies that are currently producing cash are ones that are going to get valued better, right? And so these are companies that are currently producing cash. So if interest rates continue up, these companies in general are going to continue to do well. So this, just to give you guys perspective, this is a longer term time frame, right? This is a weekly chart versus that TLT chart was a daily chart. So you could be buying this ETF at the same time you're buying TLT calls, because long term you think rates are going to go up, but you think short term there's going to be some type of whipsaw or some type of market maneuver to kind of fool people. So that's just what I wanted to highlight with this one.
Yeah, I like this one, and not just because it's an awesome ticker, but I like this one because it gives you, if you want exposure to the market, you don't want to get out of stocks completely because maybe you are worried about rates. This is a good way to play that. And as you pointed out in this chart, you really have a good level to manage risk on this. It's, you know, it's pulled back into support here. So yeah, it's a good chart. I like this one a lot. Next up, so you got another stock that's currently testing support here. This is AMD. semiconductor, a little different than the cows, as this is a tech semi name. But what are you seeing here? I see you you got that nice red support line. It's pulled back into that one.
Yeah, so I just wanted to highlight this chart and the next chart. We can look at them both quickly, is just kind of what you might want to be buying versus what you might not want to be buying. So looking at AMD, if you believe, tech is going to catch a bid here or something, you want to look at names that are holding support. So if you look at AMD is holding that 105 level, right? It pulled back, it posted a doji pattern this week. So you could see a good risk reward to the long side over 105. If you go to the next chart, because I think what people struggle with is knowing what names to look at if we do get a rebound. This is a name I wouldn't necessarily want to have exposure in, ServiceNow. Why? Because it's sitting right below support, right? We want to buy stocks that are pulling back into support, not stocks that are fading from support, if that makes sense. So I just wanted to kind of highlight that from a practical perspective, because I get that question a lot on Twitter, like what names should I be looking at? Well, look at names that are pulling back into support, kind of like the Old Country World Index, AMD, not companies that are, failing at support, right? Because now that support has become, that support level was resistance, whereas in the other example, it's still support. So that's just what I wanted to highlight with these two.
Yeah, and I think that just speaks to the bigger theme. When the market pulls back, you hear a lot of people talking about buying the dip. You got to buy the dip, but that there's not all dips are created equally. Some
Yep.
Some in this case now pulled up into resistance and got rejected there, so it's going to have a tougher time breaking out and really picking up momentum to the upside, whereas AMD or other stocks that have their dips were a pullback into support. Those are much better dips to buy. So I think that's something that people just need to be mindful of if they're in the buy the dip mode right now. This title's wrong. That's my
Agreed.
bad.
All good.
And speaking of potential stocks to buy the dip, so this is a chart of mine, but I've seen Larry share this chart or variation of this chart on his Twitter before. So this is Flex. And you mentioned before we hopped on the call that you're kind of familiar with this company's industry. Electrification of the grid is something they're involved in.
Yeah, so electrical components in general, right? So just the fact that in the United States, right, there's huge spend right now in terms of electrical components. Anything that's electric based in terms of like enhancing the productivity of the grid is catching a bid. And this is just a name that's been showing that relative strength.
Yeah, so it's a technically, we looked it up before we hopped on the call. It's technically a tech stock, but kind of has a little bit of that industrial flavor. And then if you know anything about this manufacturing boom that we're having in the United States, it's very much an IT-driven manufacturing boom. So Flex could be a beneficiary of that. But putting all that aside, when we just look at the chart here, I think this is a stock that could be a potential good dip to buy. So you can see this is a name that bottomed last summer. I like to say stocks that bottomed well ahead of the indexes as being ahead of schedule, and their bottoming process had a nice run off those lows, ripped out to new highs, had a pullback and then, ripped out and reclaimed those highs. But now we're pulling back into this key support level here right around $25. So personally, this is a name that I'm watching. I never took a position on it previously, but I want to see how it, manages and holds this key level here. But this could, potentially be a good dip to buy. Would you agree?
Agreed.
Nice. As far as another stock that's on my radar right now, not necessarily of the buy the dip flavor, but in this case, if you do think that tech is oversold and tech could after the pullback we've had already, that tech could at least put in some sort of local bottom here. I think, at least the way I approach it, I like to look at stocks that are showing really good relative strength. So this is ANET. This is a chart that I've shared many times before. I've shared both the monthly and we're looking at the weekly here, but this is a name that's holding up extremely well. You can see similar to Flex that bottomed last summer ahead of schedule, put in this big base, broke out of it. And then after that, initial really powerful run up that it had, pulled back, and sort of built out like another mini base here. I don't know if you want to call it a handle, but for the purposes of this conversation, doesn't really matter. what I like about this chart when I look at it is that we closed this past week at new highs. So this is just showing tremendous, tremendous relative strength, especially as it relates to other tech stocks. So if we do, the markets can kind of firm up and we do start to see some flows back into tech, this is a name that I'm watching extremely closely just because it's, held up so well. So I don't know if you got any thing to say about this one. This is one of my charts, but I don't know if you want to speak maybe, just about buying strength. It's a little different than the concept of buying the dip, which we already discussed.
Yeah, I mean, by relative strength, I don't think there's too much to say there. Maybe in a future video, we can dig into it more. But yeah, if you just want to buy relative leaders because momentum is a real thing. So the leaders continue to lead, right? If you're buying the S&P 500, you're buying the world's best momentum factor, right?
Yeah.
So that's essentially what we're doing, is looking for the leaders because they are the ones that we think will regain footing first, right? Just like if you look at the S&P 500 AD line that we talked about earlier, it looks like it's the one that's going to maybe bounce first from its August high instead of breaking through it. So
yeah. And in this case, because ANET's held up so well versus a lot of other tech stocks, a lot of other tech stocks have gotten hit hard. And while they may bounce, I think it's going to take a lot of these names that got hit harder a lot of time to repair the damage that's been done. This is another chart that I've shared. This is an industrial name. I just threw in some names here that I liked just from their setups, but similar to the other names I've shared today, bottomed ahead of schedule. There's been a really nice uptrend, and it's holding that rising 10-week moving average. That rising 30-week moving average is also acting as support. And when it did pull back, that trend line held. So this is a name that I've covered on Twitter before. I just like how this name's setting up within the industrial space. I don't want to say too much more about it. Another name in the industrial space that is catching my eye would be Fastenal. So this company sells everything from nuts and bolts to trash cans to gloves. It's really just basically anything that industrials manufacturing companies would need. Fastenal provides that. So I like how this one's emerging out of this big base, closed this past week green, while XLI got hit hard and the markets pulled back. So that was encouraging to see. And I just if we do start to see a potential rally, I think once again it goes back to what we were saying. The names that have held up during this pullback better, I think, have the best shot at leading going forward. So yeah, that's I think that's it though. Larry, I want to thank you for joining me. Any parting words? We don't have much time, so if
yeah, just manage risk, right? Just manage risk, draw some levels and respect them. That's really it.
Right on. All right, Larry, until next time. I think I really appreciate you jumping on this call with me though. This was fun.
Appreciate it, guys.
All right, later.